Welcome back to EDS, and in this video I'm going to show you how to trade gold profitably step by step. So the first thing is you want to open up GLD or GDXJ or GDX or some kind of gold underlying in your brokerage platform. We've got GLD up at the moment, and the reason why is because if we look in the top left, we can see the IV rank of GLD is 70.3 right now, which is very high. Anything over 30 is considered high, anything over 50 is considered to be very high. And the reason why we want to trade when the IV rank is high is because we are going to be writing and selling options contracts, and volatility affects option prices. When volatility is high, option prices are high, and because we are going to be selling these contracts, that means we're short the contracts, and we want to sell high, buy low. So when we want to sell when volatility is high, when option prices are high, and play the contraction. And one of the reasons why this works so well is because volatility is mean reverting, and another reason why it works so well is because volatility is contracting most of the time, roughly about 80% of the time in the market. So once you've got GLD open like this, you want to go over to the trade tab to where you can see a list of option expiration dates for your underlying, and the expiration date that we want to pick needs to be between 30 and 60 days out in time, and it also needs to be a monthly, not a weekly or quarterly expiration date. So as we can see here, we have March 21st with 38 days left on the contract. We can see it's not a weekly, we can see it's not a quarterly. This is a monthly expiration date. So we're going to open that up, and now we are presented with the options chain. So very quickly, we have calls on the left, puts on the right. We have this horizontal orange bar that shows us where the price of the underlying currently is with respect to the strikes going down the middle. We have our 1 standard deviation and 2 standard deviation levels denoted by these dotted blue lines. If we look in the top right, we can see the IV, which is 17.7%. And in parentheses next to it, we have the expected move, which is plus or minus 10.9, and that is denoted by or that is visually represented, by this vertical orange bar that we can see here. So now that we know what we're looking at, how do we set up the trade? How do we write these contracts? Well, what we want to do is we want to sell contracts that are going to give us a high probability of success. And when we are writing options contracts, we essentially want price of the underlying to stay away from the contracts. We want our contracts to be out of the money. So if we know what the expected move is, we simply just need to write contracts or sell contracts outside of that expected move. Now, the further out you go, the higher your probability of success will be. However, the less premium you will collect, therefore the lower your return on capital. So a sweet spot for me, in my opinion, is to be around the 1 standard deviation level, which will typically line up with 15 to 20 deltas. So on the left hand side, we've got calls, and we have the delta column here. So we're just going to go ahead and select the 14 delta. That's the closest to 15. The next one up from there is 22. And we're going to show you what the 22 delta looks like as well. So right now we're going to just go with the 14 delta at the 285 strike, and if we go to the put side, we have a 14 delta at the 253 strike. Now what you'll notice is both of these contracts are outside of the expected move. They are in and around the 1 standard deviation level, and they're between, well, around 15 to 20 deltas. All three points of confluence will typically line up every single time, and you can use that as a little checklist for when you are setting up your trades. So what have we done here? We've created a range for ourselves that we want price to stay between, and specifically we want price to be within this range at the point of expiration, which will be in 38 days time. Now, what is the likelihood of price being in this range in 38 days? Well, if we look in the bottom left corner, we have our POP, which is probability of profit, and probability of profit is your probability of making at least 1 penny on this trade, and it's currently at 76%. Now that is also visually represented by this green bar here. Now you'll notice that the green bar overhangs the contracts. And the reason why is because we collect a premium up front, which is non-refundable, and we keep that no matter what. And that premium right now is $2.09. So in order to work out our break-even points, it would be, well, it's $2.10 now, so it'd be $2.10 plus 285 on the call side, and it would be 253 on the put side minus 210. That's why our break-even points are wider than where our contracts are. And we have a 76% chance of making money on this trade, which is a very, very high probability of success. Anything over 50% is considered high. So 76% is very high. And if we wanted to get out of this trade at, say, 50% of max profit, instead of waiting to expiration, well, we have this P50 number here, which is currently over 99.5%. So you've got an almost 100% chance of making at least 50% on this trade right now. That's because our IV rank is so high. GLD has had a massive run up recently, and we've got very, very super high odds of success on this trade. Now, how much money can we make on this? So we already established that we're going to be looking to get filled at around $2 per share. There's 100 shares per contract for equities. So our max profit right now would be $207. This would be added to our cash balance upfront as soon as this trade gets filled, and that will be done automatically by our broker. Now, our buying power requirement, which is the amount of money that we need to open this position, is just over $5,300. Now, you're probably thinking this is a lot of money. We're going to collect $206 upfront, but we're going to need to put up over $5,300. Now, we do have a very high probability of success, and that's why our return is slightly lower. For something like futures, our return would be much higher in a similar setup, because it uses span margin. Unfortunately, unless you have a portfolio margin account, you don't have access to span margin unless you're trading futures. But we're going to stick with GLD, and I'm going to show you how to still get a higher return on your capital, even if you don't have a PM account and if you are looking to trade equities as opposed to futures. So what we're going to do is we're going to be a little bit more aggressive, first of all, because we've got very high probabilities of success and we want to optimize. So let's go to the 20 delta. In fact, let's go to the 30 delta, because our odds are so high on this trade. So we're going to go to the 32 delta on the call side at the 275 strike, and we'll go to the 31 delta on the put side, which lands at the 261 strike. So what we've done here is we've made a narrower range for ourselves. Our probability of profit has dropped. Our pop is now 59%, but our P50 is still 88%. It's still exceptionally high. But look what's happened to our premium. We're not going to collect $2 anymore. We're going to collect $5.68. So our max profit is now $568, and our buying power requirement is the same. Well, it's actually reduced slightly, so it's still just over 5.3k. So our return has increased. Now you might be thinking that's all well and good, however you don't want to allocate 5.3k to this trade, or maybe you have a smaller account. That's absolutely fine. So what we want to do now is we're going to use some of this premium to pay for some long contracts that are going to cover our short contracts, and that's going to get rid of this unlimited max loss potential, and that's going to significantly reduce our buying power requirement. So let's just say we go to the next strike out on the call side, which is the 280. So that's $5 wide, and we buy that contract for $1.75. As you can see, our premium has reduced. And we're going to do the same thing on the put side, still keeping it $5 wide, and that lands us at the 256 strike, and we're going to pay $1.60 and cover our short on the put side as well. So now what we've done is we've created an iron condor. Initially it was a strangle, now it's an iron condor, $5 wide on either side, and our premium has reduced because we've used some of that to pay for our long contracts. However, if you now look at the buying power requirement, that has also significantly reduced to $257 as opposed to $5,300. And the reason why is because we no longer have an unlimited loss potential. Our max loss is now $258, and our broker knows this, and it only needs to hold whatever our max loss potential is to open this trade. So where does this max loss come from? Well, it comes from the width of our strikes, or basically the spread it's called, which is $5 minus the premium that you collect, because that's non-refundable. So it'd be $5 minus $2.41 multiplied out by 100, because that's the contract multiplier, and that's how we get our max loss. So we now would be collecting $245, and our buying power requirement is $257. So we're basically getting a 100% return on our capital, as opposed to whatever it was before, which was far less. Now, in turn, because of this, our probabilities of success have dropped. Our POP is now 47%, but our P50 is still over 50%. It's 54, 55%. So this is pretty much a one-to-one trade, and we have a P50 of over 50%. So what you want to do is you want to get as many of these occurrences in your portfolio, and you want to operate a casino or an insurance company business model. You want to have as many occurrences as possible, and you want to let the odds play out in your favor. Now, these probabilities of success are not taking into account the fact that implied volatility is generally overstated compared to actual volatility, and that would increase your probabilities of success even higher. So although your POP right now is 47, in actual reality it would be higher. It would be well over 50. Your P50 would be well over 60, and so on and so forth. You can get out of this trade at, say, 25% of max profit, and you know your probabilities of success will just keep increasing the less and less or the lower you make your profit target. And that's essentially how you can trade any underlying, no matter how big or small your account is, and you just want to get as many occurrences in as possible. And you do also need to keep in mind how much buying power you are using in your account. That's very important, because size kills. You always want to manage your risk, and the best way to manage risk is by managing your position size. So in order to know how much buying power you should be using, we've created a free position sizing template that's available for everyone to use and get a hold of. The link is in the description, and the way it works is you enter in the size of your portfolio. So say if it's a $7,500 portfolio, and say if the VIX is at 29.1, you just enter that information there, and then everything will be automatically calculated for you. All you need to do is use this information to form the backbone of your portfolio. As you can see here, the maximum amount of buying power to allocate to a single defined risk position, which is what we showcase today, is $375, and the position that we looked at would fit inside of this portfolio under these market conditions. If you do have a very small account, then you may need to be slightly more aggressive, just due to the nature of it being a small account. However, try and stick to this as best as you can, and if you do have a larger account, then you should not be violating these guidelines at all for any reason. So as long as you follow this, you'll be absolutely fine over the long run. There's also an explanation here below, and if you would like to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium, get yourself signed up. Inside you will have access to our portfolio that will allow you to see the positions that we're placing, how we manage risk, how we make adjustments, all in real time. There's a full course as well, so no prior knowledge is required. We will go through absolutely everything from start to finish. And there is also a private community. Well, it is a private community, so if you ever get stuck at any point, you can speak with myself directly or with other like-minded individuals. There's a 100% money back guarantee, so once you have studied the full course and followed some of our trades for at least 6 months, if at that point you are not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's $9.99 a month to join. The price will be increasing. That's not a sales tactic. For anyone that's been a subscriber for a little while now, you will know that the price was £1 a month. we had our first wave of members join, and our first wave was full, therefore we increased the price. Now we're on the second wave. Once this second wave is full, we will be increasing the price again. But whatever price you get in at, that price is locked in for you for life. So you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to teach you the skill. And once you've learned it, it's something that you can take with you for the rest of your life. No one can ever take it away from you. It's very powerful. And we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You are, of course, always welcome to stay and be a part of the community. However, within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.